Ever scroll through social media and see these posts promising like unbelievable returns on some stock or crypto?
Oh, yeah, all the time.
Well, today we're diving headfirst into that world, specifically looking at pump and dump schemes. They're these deliberate traps, often behind those too good to be true posts. We're using insights from FinCrime intelligence.
Exactly. And we're looking at how these scams work in both stocks and increasingly in the crypto space, which can be, well, even trickier. FinCrime Intelligence gives us a great framework for understanding this.
So let's get right to it. What is a pump and dump fundamentally?
Okay, think of it in two parts. First, the pump. Fraudsters pick an asset, maybe a really small company's stock or some new obscure crypto coin. Then they blast out misleading, sometimes totally fake info online to create buzz.
Right, they generate hype.
Exactly. Get people excited, get them buying. This pushes the price up artificially. Then comes the dump.
Ah, the dump. That's when they sell.
Precisely. Once the price is high from all the hype buying, the original fraudsters sell their shares or coins, making a big profit.
And everyone else.
Everyone else who bought in late sees the price crash because of that massive sell-off. They're left holding assets suddenly worth way less. And importantly, this isn't just bad luck, it's securities fraud.
Okay, so our mission today, drawing on FinCrime intelligence, is to really break down how this works, the mechanics, where it happens, and crucially, what signs you can look out for. We want to make it clear, but, not overwhelming.
That's the plan. Understanding is key.
All right, let's talk about that pump phase first. How do they actually inflate the price? How do they get that initial momentum going?
Well, a key tactic is targeting assets that don't trade much normally. Think low-volume stocks, often penny stocks you find on, like, the OTC markets.
Over the counter, yeah. Less regulated sometimes.
Right, or new cryptocurrencies that aren't well known yet. Because there isn't much buying and selling usually, even a relatively small amount of coordinated buying by the fraudsters can make the price jump significantly. It's easier to move the needle.
Makes sense. Easier to manipulate if fewer people are trading it day to day. So they pick their target. Then comes the hype part, spreading the word.
Yes, and this is where the misinformation really kicks in. FinCrime Intelligence points to all sorts of channels. You've got online forums, think Reddit threads with supposed insider tips.
Classic.
Classic email spam still happens, promising crazy returns. But social media is huge now. Influencers pushing a coin or stock. Sometimes they might not even know it's a scheme. Other times, well, maybe they do.
Yeah, that's murky territory.
And coordinated groups on Telegram or Discord where they create this echo chamber pushing everyone to buy, buy, buy. It creates this intense FOMO fear of missing out.
Ah, FOMO, the big driver. So they're basically manufacturing excitement.
Totally. It looks like genuine market interest, but it's all orchestrated to lure in retail investors.
Yeah.
They're playing on that herd instinct.
Okay, so the pump works, the price is inflated, then comes the dump. What does that actually look like? Is it just one big sell order?
It's usually rapid. Once the scammers feel like the buying frenzy is peaking, maybe they see the momentum slowing, they start selling off their holdings very quickly.
Before it turns.
Exactly. And because they often hold a significant chunk of the asset, especially these illiquid ones, their large sell orders flood the market. There aren't enough buyers at that high price anymore.
So the price just tanks.
Plummets.
Yeah.
Often just as fast as it went up.
And the people who bought in, hoping for quick riches, what's the fallout for them?
It's usually pretty grim.
Nothing.
They're stuck with assets that have crashed, often way below what they paid. And as FinCrime Intelligence notes, because these assets often lacked real fundamental value to begin with.
There's nothing holding the price up.
Right. And because they were illiquid, it can be hard to even sell them at the lower price. You might be stuck. Plus, getting your money back legally, especially with crypto on less regulated platforms, very, very difficult.
Oof. That's rough. So let's clarify where these schemes are most common. We mentioned penny stocks and crypto, but can you elaborate a bit?
Sure. FinCrime Intelligence points to penny stocks on OTC markets as a consistent target. Also, microcap or small cap companies in general, maybe because there's less public info available, making it easier to spread rumors.
Less scrutiny.
Less scrutiny, lower trading volume often, and definitely the newer, more obscure cryptocurrencies, especially ones on decentralized exchanges or platforms with lighter regulation. It's just, well, an easier environment for scammers sometimes.
And the online hangouts, where do these groups coordinate?
Telegram and Discord are really big for this. Private groups, channels, broadcasting signals.
Yeah, I've seen those advertised.
Reddit subreddits can also be used to build hype. And YouTube, with influencers potentially promoting these things to huge audiences. The speed and reach of these platforms are perfect for making a scheme go viral fast, globally even.
It's the dark side of that instant communication. Okay, critical part now. Red flags.
Uh,
How can you, listening right now, spot a potential pump and dump before getting caught?
This is really key. FinCrime intelligence gives some clear indicators. First, look for sudden, huge price spikes in an asset, especially if there's no obvious news or reason for it. And often, these are followed by sharp crashes.
That volatility itself is a warning.
Absolutely. Also, watch for unusual spikes in trading volume. An asset that barely traded before suddenly sees massive activity. Be suspicious.
Okay, what else?
Big one. Promotions guaranteeing returns or claiming inside information. Real investments don't come with guarantees like that if it sounds too good to be true.
It probably is, yeah.
Check for credible news. Is there a real company announcement, a filing, anything substantial explaining the price move? If all the buzz is just anonymous forum posts or social media hype, that's a major red flag.
And you mentioned coordination.
Yeah, if you see the same stock or coin being pushed hard across lots of different channels, Telegram, Twitter, Reddit, maybe a YouTube video, all popping up around the same time, that suggests a coordinated effort, not organic interest.
It's interesting. FinCrime Intelligence also notes that from a compliance side, banks and exchanges watch for these exact same things. That sudden volatility, the volume spikes, those things can trigger alerts for them, maybe even leading to a suspicious activity report, a SAR.
Exactly. The patterns are often quite clear when you have the right surveillance. So, what happens if they get caught? Are there real consequences?
There can be. Pump and dumps are illegal pretty much everywhere. FinCrime Intelligence mentions major regulators like the SEC in the US, the FCA in the UK, actively pursuing these cases.
And the penalties.
Can be severe.
Yeah.
Heavy fines,
Right.
having to pay back all the profits they made. That's called disgorgement.
Oh, disgorge.
They can be banned from trading, lose licenses if they work in finance. And yeah, for serious cases, criminal charges can mean jail time.
So there are teeth to the regulations, but FinCrime Intelligence also mentions it's not always easy to enforce, right?
That's true. Enforcement can be challenging. Often, action happens after the damage is done.
Reactive, not proactive.
Yeah. And these schemes can be complex, especially with crypto. Think about the anonymity, the fact that transactions cross borders instantly, tracking down the actual people responsible, navigating different legal systems. It's tough for regulators.
I can imagine. It's like a global game of whack-a-mole sometimes.
Kind of.
Yeah.
But technology's helping on the detection side, isn't it?
Yes, definitely. Market surveillance is getting much more sophisticated. FinCrime Intelligence talks about using real-time data analysis, machine learning, AI.
Finding patterns.
Exactly. These systems crunch huge amounts of trading data looking for anomalies. They can spot trading that just doesn't fit the history of that stock or coin. They can find clusters of accounts trading in suspicious coordinated ways.
Like they're all acting together.
Right. And they're getting better at linking those weird market surges back to specific promotional campaigns happening online across different platforms. So you see a spike and you see the coordinated hype campaign starting just before it.
Connecting the dots.
Connecting the dots. And there's definitely a growing expectation now for exchanges and financial institutions to use these kinds of tools to protect the market.
That's good to hear. So, bringing it all together, what's the best way to protect investors and, ideally, prevent these schemes in the first place? It sounds like it needs multiple approaches.
It really does. FinCrime Intelligence emphasizes it's not just one thing. You need strong regulation and enforcement, yes, but also huge emphasis on investor education, making sure people like you listening know these red flags, and strong compliance within the industry itself.
And specific preventative steps, what do they suggest?
Well, continuing to raise awareness is number one. Making sure retail investors understand the risks, especially with unsolicited tips or hype, maybe requiring more transparency, better disclosures from those smaller micro-cap companies.
Making it harder to hide behind obscurity.
Exactly. Stricter rules for getting listed on crypto exchanges or OTC platforms could help too. And, as we mentioned, actively monitoring social media and public forums for that coordinated hype around thinly traded assets can give early warnings.
So to wrap up, pump and dump schemes are all about manipulation, using hype and false information. They prey on specific kinds of assets, use predictable online channels, but importantly, they do have warning signs you can learn to spot.
Absolutely. Being aware of these tactics, being skeptical, that's your first line of defense. Don't let FOMO override your common sense.
And just a final thought to leave you with, drawing from FinCrime Intelligence's broader focus, Think about how interconnected everything is now. Online platforms, global financial markets. It creates amazing opportunities, sure, but
Mhm.
also, well, fertile ground for these kinds of scams to spread incredibly quickly. It makes you wonder, what role does our own individual awareness and skepticism play in keeping the system, healthier?
That's a really crucial point. And if you do want to learn more about protecting yourself as an investor, checking out resources from organizations like the SEC or the UK's FCA is a great next step. They have a lot of helpful information available.